Well, behind the noise of US economic troubles, a much bigger financial catastrophe is taking shape in Tokyo. For over 30 years, the Japanese yen was treated as the ultimate safe haven, a stable, predictable currency anchored by near zero interest rates. But over the past few years, the yen suffered a historic collapse, plummeting from 105 yen per dollar to over 161, a staggering 35% drop in purchasing power. If you think a currency falling on the other side of the planet doesn't affect your wallet, think again. That weak yen created the largest free money system in modern history, funding Wall Street stock rallies, US real estate, and tech investments. Now, as Japan is forced to normalize its economy, that massive financial engine is starting to unwind. Here is how Japan's currency crisis works, why it happened, and what it means for every American investor. To understand why the yen matters so much to Americans, you have to understand a Wall Street mechanism known as the yen carry trade. For decades, Japan struggled with economic stagnation. To fight this, the Bank of Japan pushed interest rates into negative territory, sitting at minus 0.10% for years. Meanwhile, to curb domestic inflation, the Federal Reserve raised American interest rates above 5%. According to data from the Bank for International Settlements, global banks and hedge funds built up over $1 trillion in cross-border yen loans. The strategy was simple. Borrow billions of yen in Tokyo at near zero interest. Convert those yen into US dollars. Invest those dollars into high-yielding US treasuries, tech equities, or corporate bonds paying 4% to 5% returns. Even as the Bank of Japan steadily normalizes interest rates toward 1.0% and the Fed adjusts, that interest rate gap remains a massive driver of global capital. While global hedge funds profited from cheap yen, the Japanese economy began paying a devastating price. Because capital kept flowing out of Japan toward higher yields in America, the yen crashed. To stop the currency from breaking past 160 per dollar, Japan's Ministry of Finance burned through nearly $62 billion in foreign exchange reserves in a single month, one of the largest currency interventions in history. Normally, a central bank stops a falling currency by quickly raising interest rates. But Tokyo was caught between a rock and a hard place. Japan holds a national debt of over 1,300 trillion yen, more than 234% of its entire GDP. If the Bank of Japan raises interest rates too aggressively, the cost to service its own government debt explodes by billions annually. Tokyo was trapped. Let the yen collapse, or raise rates and risk blowing up its own government budget. We don't have to guess what happens when the yen carry trade unwinds. We already saw a real-world trial run. On August 5, 2024, a minor 0.15% rate hike by the Bank of Japan triggered a global margin call. The Japanese Nikkei 225 suffered a brutal 12.4% single-day crash, its worst drop since 1987, while hundreds of billions were wiped off US tech stocks in under 48 hours. When Japanese interest rates rise, the liquidity trap closes on American markets. 1. Forced asset sales. Hedge funds must sell off American stocks and corporate bonds to pay back their yen loans in Tokyo. 2. The Treasury squeeze. Japan is America's largest foreign creditor, holding over $1.14 trillion in US treasuries. If Japanese institutions bring that capital home to chase higher domestic yields, buying demand for US debt drops. 3. Main Street impact. Fewer buyers for US treasuries pushes up the 10-year yield. And when that yield spikes, 30-year mortgage rates follow, pricing everyday Americans out of the housing market. The Japanese yen is no longer just a foreign currency. It is the cornerstone of global market liquidity. As the Bank of Japan continues its delicate policy normalization, the global economy is discovering that unwinding decades of artificial cheap money comes with immediate structural consequences. How do you think these central bank shifts will impact US real estate and stock markets over the next year? Drop your thoughts in the comments below, like this video, and subscribe for more deep dives into global macro finance.